This is Abel Tejeda with the Mortgage Guys, and in this video I'm going to share with you how you can use the equity of your existing home to purchase a new house. Maybe thinking right now is a great time to buy a second home or invest in property, given that home prices are going up so rapidly. And buying a second property, investment property, is in everybody's mind. So here are the three ways that you can do that. Obviously, there are other ways, but let's just discuss and focus on those three. Number one, refinance your existing property. The first option you may consider is refinancing to take the cash out. A cash out allows you to tap into the equity of your home, take some of that money, and there you can either, depending on where you want to buy, you can either pay it all off or just take money out for the down payment. So depending on how much equity you have, and depending on where you want to buy the property, and depending what the value are of the properties around your area, that might be a good option. Another option is to take a line of credit out on your property. You are tapping into the equity of your home, but the main difference here is that you're basically not touching that first. That first remains there. So basically you're getting a second mortgage based on the equity. The good thing is that if you get a line of credit, you don't pay on that money until you start using it. So for example, let's say you owe $200,000 on your home right now, property's worth $700,000. This is the perfect scenario because it's happening everywhere, especially in California. And you want to buy another property and you need $200,000. So, but you don't have a property identified yet. So what you can do is go to your bank and ask them for a HELOC, which stands for Home Equity Line of Credit. So it's basically what it sounds like, a line of credit. It works like a credit card. You only pay on the balance. So let's say they give you a $200,000 line of credit or HELOC. You'll have your first for $200,000. You're only paying on the $200,000 because you're not utilizing anything over here on that line of credit. Now let's say you want to use that money. You go, most of them give you a checkbook, you write a check for $200,000, and there, just like that, you have the down payment for that other property. Now, what are the downsides? This is something that we have to be careful on example A or option one, which is cashing out from your home. The downside is this: you start making payments right away. So if you owe, going back to our example, if you owe $200,000 and you now you want another $200,000, now you're making payments on $400,000. So just keep that into account. A lot of times it makes sense, especially if you're renting out the other property, because it's generating revenue, generating money for you. So it makes sure it offsets and you're creating a profit. There's a saying always, when buying into real estate, the money is made before you buy the property. So make sure that you're either going with equity or based on the calculations of how much rent's going for in the area, that you are going to be positive. You don't want to be paying money out of pocket. It's supposed to be an investment, it's supposed to be making you money. So be careful with that, just because your mortgage will increase, obviously, especially if you're going from $200,000 to $400,000. You have to have reserves. I would advise you to have reserves just in case that renter moves out, or imagine like it happened with COVID during the pandemic, that renters didn't have to make their mortgage payment, or actually their rent payment. So that can put you in a bind, so be careful with that. What is a drawback or a downfall from a HELOC is that most of them are a 10 or 15-year loan with a balloon payment, and eventually you will have to refinance. So most of them are adjustable, so be careful with that. That's great when rates are low, but right now the rates are going up. You don't want to be caught with one of those loans and have to refinance in the future, especially if you have a killer rate. Let's say you have a 2.5 conventional, and then you have a HELOC or line of credit for, let's say, below the 200,000 at 6%. But now you want, and be careful also, because your rate is not really the rate you have on the first. Your effective rate is the rate combining both, given the weight of the total. So don't be fooled by thinking, oh, I have a 2.5. No, you don't. Especially if you have an outstanding balance of 200,000 at 6%, that will be completely a different rate. So eventually, if you don't pay it off, eventually you will have to consolidate your first and the line of credit into one to avoid the balloon payment or to avoid rising interest rates. So be careful with that. Everything makes sense if it's done properly and carefully. So if that's something you want to do, give me a call, 619-948-2996, or email me, Abel, A-B-E-L, at abeltejeda.com. I'll be more than glad to sit down with you and hear you out, hear what your plans are, and give you my input. Give you the positives, the negatives. We can strategize and set up a plan for you. Once again, Abel Tejeda, the mortgage guys, and I'll talk to you soon.